I'm Rhonda Schaffler on the floor of the New York Stock Exchange with Jim Cramer. Jim, a lot of people looking for advice in a market like this. What do you tell investors?
I tell people what I'm doing. For Action Alert, we're putting about, we fortunately had a nice cash position because we did some selling last week. Starting to apply that cash in situations. Those, you actually should subscribe to see what we're doing. I'm not going to cheat our subscribers. For my 401k, I put some money to work last week, but not enough. I have to put some more money to work today. I'm not going to be aggressive because I think that day two, if the blast zone, so to speak, today, is going to be worse, if only just because people who didn't have a chance to sell are going to come in and sell with market orders, and that might be an opportunity. So put some more money to work here. Now, if you're margined, obviously you have no choice but to sell. If you're in huge oil funds, you're going to have to sell. If you're 100% invested, any lift today is a good opportunity to sell 5% of what you have is profitable. No one ever got hurt taking a profit. When we left on Friday, more than 400 of the S&P 500 were still up versus where they were 2 years ago. So you probably do have a profit in some things. I'm only suggesting that if you are 100% invested, because you might get an opportunity to switch around, buy some other things. Look for dividend yield funds. There's a Wisdom Tree dividend yield fund. There's Fidelity has a bunch of dividend yield funds, Vanguard. And be there, because this is also a market that is going to react to the fact that you have very little money going to be made in Treasuries. Certainly do better in dividends, as long as they're not oil dividends, which I think are suspect.
And Jim, historically, after corrections or pullbacks in the market, if you look at what the stock market does over 5-10 years, you recover that money and then some.
Oh, even before then. The problem is that we're not down as much as we have been in other collateral damage situations. I mean, if you take a look at 1997, you were down 12%. 1998, you were down 19%. In 2011, with the Italian and Irish and Portuguese and Spanish situation with Greece, you were down 17%. So, I mean, we actually have some more work to do on the downside for companies that are internationally oriented. Not that much more work to do on the downside for companies that are domestic. I know that means that you have to think, wow, you know what, if I buy the S&P fund, 27 out of 30 stocks in the Dow have international exposure. You may be hurt by some of the international, but you know what's odd, Rhonda? Estimates probably have to come up because so many companies do business in Europe. The commodity costs are so down for so many, like a PepsiCo, whatever. It's just that I can't suggest to you that things are sanguine, if only because the Federal Reserve hasn't come out and spoken, and China is a disaster. And what's happened, this is about the second largest economy being revealed as a paper tiger. The Chinese government didn't know what they were doing when they tried to keep stocks up. They didn't know what they're doing when they encouraged individuals to come in and use margin. We have to clean out China, and China is NASDAQ 2000. So be aware that the Chinese index has to fall 1,000 points within the next few weeks to be back to where it was before the rally began. I don't know how it can't overshoot that. So if we're really trading it one for one with China, which is unfortunate, but we are, then we have another down day tomorrow. Because I don't think the Chinese can keep the stock market up, since so many of those companies, and I reviewed a lot of them this weekend, are, well, let's just say questionable companies.
Jim Cramer, thanks for that much needed and appreciated advice today. I'm Rhonda Schaffler for The Street.